Good morning, everyone. It's 11 a.m. on September 15th, 2020. My name is Brad Shavely, Vice President of Capital Management Corporation. We appreciate everyone taking time to join us for today's webinar. What's going to happen to the estate tax, and does a Grantor Trust make sense? Definitely a big subject to cover on webinar, but we hope to cover a lot in a relatively short time. We plan on doing a brief slide presentation here for about 10 to 15 minutes, and then opening it up to Q&A. With Q&A on the webinar, you can go to your questions toggle down below and type in your question, and we'll address them as they come in. We've already received quite a few that were emailed to us. But with that, I am pleased to introduce our speaker today, Robert Freed. He's co-founder of Freed and Shepherd Law Firm and has over 40 years experience practicing estate law, having been recognized by a number of publications and peers for his legal work in estate planning. With that, I will pass it over here to Robert. Robert, you there?
Hi, this is Robert Freed, and I have the pleasure of speaking to you about estate taxes and grantor trusts. And the first thing we need to look at is the potential changes that will come about if the Democrats sweep the House, Senate, and the presidency. These are Biden's proposals. Currently, a single person can pass about $12 million tax-free, and a couple can pass about $23 million tax-free. The Biden proposal will take this to $3.5 million per person and $7 million per couple. If you're lucky enough to be worth about $23 million, that will be an additional $6 million in estate taxes. So we can see that planning is important, and most importantly, planning is important in 2020 should these laws pass to use the full 11.58 exemption. Anything that's taxed for estate tax purposes is taxed at 40%. Now, while I'm not going to focus on the income tax, we do need to look at the Biden proposals from an income tax standpoint. The rates will increase. There'll be an elimination of some deductions. Biden says this isn't going to affect anybody who makes less than $400,000. And so forth. The fact checkers seem to indicate that that is the case. About the best thing I can tell you is after the election, if there is a sweep, you need to talk to your CPA before the end of the year. Brad, how about the next slide? So, what are one of the techniques that we can use to reduce the estate taxes? And what I'm going to speak about today are grantor trusts, specifically intentional defective grantor trusts. Brad, next slide, please. Now, what's a grantor trust? It's a trust that all of the income of the trust is taxed to the grantor. This is important. It's not taxed to the trust, but the grantor is taxed as if he owned the assets that are in the trust. Essentially, the trust is made transparent for income tax purposes. So what's an IDGT, intentionally defective grantor trust? This is one where we set out to purposely make the trust intentionally defective. And the reason we do that is we want the income tax to the grantor, but we want the assets in the trust to be out of the grantor's estate so that there are no estate taxes paid by virtue of the trust. And we're going to talk about how we do that in a little bit. Lots of trusts are grantor trusts. There's GRATs, Grantor Retained Annuity Trust, Grantor Retained Uni Trust. Many of you probably have revocable living trusts. Those are grantor trusts. But we're going to focus on intentionally defective grantor trusts today. Brad, next slide, please. So, what can we do with an intentionally defective trust? And remember, trust that is taxed for income tax purposes, but not for estate tax purposes. Well, what we get with the use of the IDGTs is we maximize assets that pass to the next generations. And we can use it to skip the grantor's generation. We can use it to skip the children's generation, and thus avoiding taxes at different generations at the death of the people who belong to those generations. Certainly, the primary use of the IDGT is to minimize estate taxes. Now, one of the reasons we use the IDGT is that the income is taxable to the grantor while the assets in the trust are excluded. Now, what happens is because the grantor has to pay income taxes on the trust's income, that's an additional gift to the trust. That moves additional assets out of the grantor's estate and into the trust by virtue of the grantor paying his or her own income taxes. And that's a tax-free gift. That's a powerful tool. Other uses are we can protect family assets. Parents are very worried most of the time about their children getting divorced and these assets going to the divorced spouse. And parents who have spendthrift children are worried about their children's creditor problems. And we can use the IDGT to protect the beneficiary from those financial risks. One of the most interesting questions I get when we're designing an IDGT is, I don't mind giving the assets away, but I want to benefit from the income. Now, we can't do that if we're going to avoid the estate tax. What we can do is allow the trustee to make distributions to the grantor's spouse. And that gets the money out of the trust and into the spouse's hand, who hopefully will use it for family purposes when it's needed. And just in case you think IDGTs are only valuable tools for people who are worth $23 million, they're valuable tools for just about anybody who is over the exemption amount, which, as I said, may become $3.5 million soon. So, Brad, next slide, please.
Ooh. Oh.
I think we're at the end.
Yeah, we are. So with that, we will start taking questions here. And I will go ahead and have one here that was sent in. Robert, can the parents that set up Grantor Trust for their children maintain control of both the investment management and withdrawal of funds?
Well, to keep things simple and moving this along, I'm going to assume we have a Grantor Trust. That's usually not the problem. When answering these questions, I'm going to focus on the estate tax issues that the question rises. So the answer is, focusing just on the estate tax, no, the grantor cannot control the assets. And the reason is that control makes the grantor the owner of the trust assets for purposes of the estate tax, which essentially means that the assets of the trust are going to be estate taxed at the grantor's death. Now, we can make the spouse a distributee. We can make the spouse a trustee. We have to be careful when we make the spouse a trustee that we don't include the assets of the trust in her estate when she dies. But that's relatively simple, and what we do is we limit her distribution powers to health, maintenance, support, and education, which are pretty broad powers. Any more questions?
Yes, we have some more. And once again, if you have a question, please feel free to type it into the question box, and we'll address it. Next question here is, once the grantor trusts are funded, can the parents have access to the trust assets?
grantor cannot. So no one can have a power to distribute to the grantor. And there are pretty sophisticated reasons for that, so I'm just going to ask the crowd to take my word for it. But, as I've said in the prior question, we can give the spouse certain distributions and make her the trustee subject to health maintenance, support, education. So the spouse can be in control of the trust assets from an estate tax standpoint. And for those of you out there who have irrevocable life insurance trusts in place, more likely than not, the grantor's spouse is the trustee of that trust. And that irrevocable life insurance trust can or cannot be a grantor trust depending on how it's drafted. So the simple answer is not the grantor, but the grantor's spouse if the documents are properly drafted.
Okay. Can a trust be established and the children not know the dollar amount transferred?
That's an interesting question, and I don't have an answer for it. I will tell you that some of my documents have confidentiality provisions in it so that the trustee doesn't disclose any information unless a court orders the trustee to do so. So whether or not that's effective in Virginia or not, I don't know, and hopefully I won't have to test it while I'm practicing. But I will say there is what we affectionately refer to as the big stick power, and that is a child comes in and says, I want some money out of the trust. The parent says no. The child says, well, I want to know what's in the trust. The parent says no, and the child isn't very happy with those answers, and someone, most of the time it's me, reminds the child that this is just the tip of the iceberg, what's in this trust, and there's much more to come. And without threatening the child, we make sure the child minds his P's and Q's by using the big stick. And so far in my career, that has worked almost all of the time.
Okay, great.
Next question.
Yes. We have another question here around funding of the trust. And we're just looking for a little discussion about whether you should do it immediately, over time, when the parents are tax harvesting. What's the best way and timing to fund a trust?
The best time is any time, and the sooner the better. And the reason is the sooner you get the assets into the trust, the sooner the income and appreciation of those assets are removed from the grantor's estate. So the sooner you begin, the more income and the more appreciation is removed from the estate tax regime.
Okay, great. We got another question here, Robert. It says, in light of the election coming up, and it's now September 15th, should we be looking to set up a grantor trust now, or can we wait till the new year? Or is there going to be a logjam, heading into the end of the year?
Well, I tell you, prognosticating tax changes is dangerous. I once had a client make me prognosticate that what was going to come in the change in the upcoming law, and I guessed it cost my client about $400,000 in additional taxes. So I want to guess as to what's going to happen, but I will tell you that depending on the election outcomes, the chance of these changes that we're talking about are pretty good.
Okay.
There's some sophisticated reasons for that, but I think generally, if you look at the percentage of taxes that the U.S. government collects their gross domestic product, we're pretty low on the totem pole for industrialized countries. So if we continue to reduce that percentage over a period of time, we are going to get ourselves into some financial problems.
You know what? One last question here, and then we'll conclude this. But can trust be set up where, in cases of a child divorces, or I'm sorry, in cases of a death of a child, or there's a divorce situation, how does that impact a trust?
Well, if the parent is concerned about divorce or creditor problems, we have ways of drafting the trust so that most creditors, not all, but most creditors can't get at the assets of the trust. All the creditor can do is get to the income or cash distributions that are made from the trust to the beneficiary. And it's a powerful tool. I just had a case with the Internal Revenue Service where they had a lien for, I don't know, about $250,000 against the taxpayer. It was essentially penniless, but he had an interest in his mother's trust, and I had the right provisions in the trust, and that kept the IRS from getting at the assets of the trust. But essentially what we do is we sprinkle the income and principal out. We pay it out to people other than the debtor beneficiary. For example, his children, maybe his wife, other children of the grantor. So we make sure that the debtor beneficiary doesn't ever get any money in his hands that's subject to seizure by the creditor.
Okay.
As far as the second part of the question, what happens on death, I can't say there's a general rule, but most of the time, parents will leave it to the child's children or grandchildren if the child's not living at the time of the parent's death. That's the majority. Some people leave it to charity. Some people leave it to other family members. But I would say most of the time, many times, almost all the time, most of the times, parents leave it to their children, and then their children's children and their children's grandchildren is the usual distribution pattern.
One last question was typed in here. How is a irrevocable living trust different from a grantor trust?
Revocable or irrevocable?
No, revocable.
Revocable. So that person's talking about a living trust. And essentially, a living trust, if it's designed properly, is a grantor trust. In most living trusts, the grantor is the trustee until he dies or she dies, and gets all of the income, and most importantly, has the power to revoke the trust. And that power of revocation is what makes the trust the living trust a grantor trust. So I'm going to say almost all. I can't think of any examples, but may be able to say all living trusts are grantor trusts.
Okay. Well, in conclusion, I really appreciate you taking the time here today, Robert, and running over this with us. We will be posting up a replay of this on the Capital Management Corporation's website. And if you have any interest or further questions, I have up here this contact information for Robert. So feel free to reach out to Robert. I hope that's all right, Robert.
Yes, that's fine.
Okay. But once again, we really appreciate everyone's time and look forward to talking to all of our clients here going forward. And we hope that everyone stays safe, obviously, in these uncertain times that we're experiencing. So with that, we will conclude today's presentation. And once again, thank you so much, Robert.